Hello fellow traders, today we have a tutorial about proper risk management. Have you been trading and looking every 5 minutes to the charts? That's because you're trading money that you can't afford to lose. Have you been losing a lot of money? That is because you don't have good risk management. When you have good risk management, you can sleep easily and don't worry if you lose it, because you lose only the amount you are comfortable with, and proper management states not more than 1 to 2% of your whole portfolio. So let's dive into it. What is risk management? Risk management refers to the process a trader puts in order to control the losses and prevent him or her from losing all the money. Proper risk management normally would be risking not more than 1 to 2% of your whole wallet per each trade. For example, if you have a $5,000 wallet and you want to risk 1% of it with each trade, you only risk $50. And this may sound a little bit of money, but trading is all about consistency. It's all about percentage. Forget from your mind the amount of dollars you're gonna lose or you're gonna gain. It's a game of percentages. So stick with that. Proper risk management also includes consistent, realistic profit targets. Don't aim for higher targets that might take too long to get or might not even get there. Always go with a 1 to 1.5 risk reward or 1 to 2 risk reward ratio. What is that? Go for risking $1 to gain 2, risking $1 to gain $1.5. That's it. Don't aim for with $100 trade you want 1,000 profit. It's not realistic, it's not consistent, and you're gonna fail eventually. You might get fortunate 1 or 2 or 3 trades, but it's not consistent. Now let's move to some examples, and I'll show you this chart to properly know how you're gonna trade this theory. So for this example, we're gonna take a wallet size of $5,000. 1R is our 1% of our wallet, so it's $50. And we're gonna work with a risk reward ratio of 1:2, or in other words, risking $50 to gain $100. So let's say out of 100 trades, because everything in trading needs consistency and you need to take at least 100 trades. You can't know that you're consistent only on 4 to 5 trades. So let's say that you're a medium trader. You lose 50 trades and you win 50 trades. This would mean for you that when you win 50 trades times 2%, which is the $100, and that gets you a $5,000 profit. While when you lose those 50 trades, you only lose half of it, 1%, which is $2,500. So at the end of it, after 100 trades, reducing the 2,500 out of the 5,000, you still get 2,500 in profit after 100 trades, which is quite good. And you'll end up with your initial deposit, which was $5,000, and the profit including with it, which your portfolio would be $7,500. Sounds good, right? That's one method how you do it. Another example, and we'll go slightly faster because it's the same example, but this one I like it better than 1.2. 1 to 1.5, which would mean risking 50 to gain 75. As you can see, at the end of the day, you still get $1,250 in profit if you work with this ratio and if you have a 5K wallet. If you have a 10K wallet, this would double. If you have less, it would of course decrease, but it's not about the amount of money. It's all about the percentage. So how do you trade these things? For example, today I was talking to to one of my friends, and when I told him, listen, don't risk more than 1 or 2% of your portfolio. He told me, how do you get that? So let's dive into it. For example, let's move on a chart that I just traded today, UTX, and for other reasons that we will enter on another tutorial, I want my stop loss to be here, okay, under this blue line which has been supporting the price, and I want it slightly below it, so my stop loss I want it at 6.06202, and my entry would be at 0.06846, and my target profit I want it below this resistance channel, which of course I want it like that because it might reverse when it touches. So first of all, is it worth it trading this trade? Let's check out. On TradingView, when you pull out the long or short position, you can see here risk reward ratio, and if you move the stop loss or the take profit, you can see that it varies. And I want a minimum, always a minimum of 1.5. Sometimes I accept 1.4, but a minimum to 1.5. So that trading strategy that I just showed you, the good risk management, would apply with this trade. And how we do that? Let us get an example, a live example on Bybit. So for example, we're gonna use Bybit for the OTX trade. We're gonna use an account that I usually use for a new project. I'm starting a project, how to make $50 in $5,000. I started today. I'm gonna record some trades and eventually we'll get a series out of them. So I have an account of $49.78. Okay, it's a $50 account. And for this particular example, we're gonna use not 1%, but 10%. I know that I preach 1 to 2 maximum as percentage, but on a $50 account, 1% would be 50 cents. So it doesn't make any sense. So for now, we're gonna risk $5, a 10% risk ratio. Okay, so for this trade, UTX, we're gonna enter at 0.06846. So our limit order is 0.06846. Our quantity will leave it random for now because that will determine our risk reward ratio. Our stop loss is at 0.6251. So we tick the buy long with stop loss and take profit, and it was 0.6251. 0.6251, and our target is 0.7734. 0.7734. So now made something wrong. Oh, a zero missing, and the zero missing here. Okay, so you can see that at our stop loss, which we determined according to a strategy we use, you don't determine stop loss according to the risk reward ratio. You implement a trading strategy, which should be anything you have, and then implement it here, and the amount you're gonna lose, you're gonna increase it or decrease it according to the coins you're gonna buy. Okay, so important, stop loss should be positioned according to a strategy you use. So we can see that our loss is $2.92, so we can increase our purchase. Our purchase will be around double of it, around 860 coins. We're slightly higher, so 84541. Okay, so we're at $5 risk for this trade. It's our 10% for this example. And as you can see, of course, If we normally we risk 1% to take 1.5 as a profit, right now, because it's a very small account, we're gonna use 10% to get 15% in profit, which is our $7.44. So that's a realistic example on how to trade with good risk management. And of course, then you need to implement a good trading strategy, which we'll get to in another tutorial. But for now, stick to good risk management. So going back to our presentation, with the $50 wallet, if we use the 10% risk reward ratio to 15, we are risking $5 to get 7.5. And after 100 trades, you can see that we win 50 trades and we lose 50 trades. We kept it like that. Our profit would be $375 and our loss would be $250. And as you can see, after 100 trades, we will still be in $125 in profit. Of course, this is very small. It's peanuts as a profit. But remember the percentage. It's more than 1x in total profit. Actually, it's 1.5x. Okay, so if it was a 5k portfolio, that would mean about 12k, 12.5k, something like that. Okay, so remember, it's a game of percentage. But you can do it even with a small account, even with $50. If you are in for the pain and everything and the annoying, like $5 to $7 to $10 profit per trade, yes, you still can do it. Everyone can do it. Just be consistent and trade only 1 to 2% risk reward ratio. And I'll give you an example. Imagine you're risking 10%. And of course, you might have 5 to 6 losing in a streak. You'll never win 10 trades in a row or 15 trades in a row, or you win one and you lose one. Sometimes you get a bad week and you lose 6 in a row. Imagine risking 10% for every trade. You lose 60 to 70% in 1 week. Your whole portfolio would be gone. Why is that? Because you'll get emotional. After 60%, what do you imagine you'll do? With those 30 to 40%, you'll high leverage your trade, and eventually you'll end up emotionally and you'll lose everything. So stick to this risk reward ratio. Good risk management at the end of the day will reward you. Bye bye and see you for another tutorial.